Hello, my name is Cameron Stewart, CFA. Thank you very much for watching Rational Investing. I greatly appreciate the comments and subscribers on the channel. The comments down below are fantastic. There are tremendous value-focused investors commented down below. Definitely check that one out. This week up, we're going to cover Etsy, the online e-commerce marketplace for creative buyers and sellers. We're going to take a look at the stock. We're going to look through their 10K, their most recent quarterly earnings. We're going to look at 9 years of financial information. We're going to figure out what we believe this stock is worth. And then we're going to look in the market and see what we can buy it for and see if there's an outsized return we can get by owning the stock. Let's get to work. Before we begin the cash flow analysis of Etsy, let's review our 5 key attributes. The first one, top line revenue growth, we must have it. Number 2 is earnings growth. We use Ebitda. Enterprise level earnings must be growing. Number 3 is strong free cash flow. Number 4 is low debt. I want to see less than 3 times debt to Ebitda. And number 5 is a well-priced stock, well-priced being enterprise value to Ebitda. We need all 5 of those to line up for us to consider it an investment. We can then do further market research to determine do we actually want to put our money in it. But at the basic core business, it needs to have those 5 key attributes. All right, let's dive into Etsy. Behind me is the 10K filed December 31st, 2020 for the annual results of Etsy. Highly recommend you print it out and take a read through it. It's got all the detail you need in black and white. It's why I go to the 10K and not the investor relations presentations, which are sales pieces. But this is a fantastic read. The very first section is the opening letter from the CEO, Josh Silverman, outlining a phenomenal year. They absolutely crushed every metric possible, and he does a very good job outlining that in this letter and summarizing his 5 years of leadership post-IPO. Congratulations, sir. Great job. Let's take a look through this 10K. I want to review a couple key metrics for you, walk through the balance sheet, cash flow statement, then we'll look at long term. Before we get into the detail, I want to show you this chart, which I actually really like. It shows customers, and I apologize for being in black and white. That's 10Ks. They're always in black and white. But the dark zone here is first-time buyers. And over the years from 16 to 20, you can see that has been growing nicely with a huge pop in 2020 for the COVID bounce. Aside from this lighter gray box is multiple purchased buyers. And then finally, habitual buyers being the super light gray. And what I really like to see here is the expansion of all categories as I go from 19 to 20. It looks like, in fact, throughout here, it looks like all the groups are growing. This particular year was an absolute monster as everyone stayed home. Both the buyers of buying and the people making product were home, so everybody could make something. And that's how we got an explosion here of transactions. Let's hope they can continue this going forward. One big risk for me in this business is, given this trajectory, right, what do you do with this number? Does it pick up and grow from here, or does it kind of revert to an average and then go back? I don't know. We need to take a look and make sure the return of buying the stock can handle that kind of fluctuation early on. But let's take a look at the financials quickly. Okay, behind me is the December 31st balance sheet of 2020, and I apologize, this is as big as I can make it because it's just simply so wide. So I'm gonna read it. I won't stay long too much. You can print this out on your own leisure. But current assets, cash and cash equivalents, $1.2 billion in cash, up from $440 million the prior year. Strong cash generation, strong current assets. If I scroll down quickly to roll through this for you, very little debt. Total liabilities, not just long-term, but everything, $1.6 billion, meaning they have more current assets than all of their liabilities combined. That's a great scene. Long-term debt, they have a little over $1 billion of actual long-term debt. So overall, this balance sheet to me seems extremely healthy, with cash essentially covering all of the outstanding debt. Again, the cash largely coming from the one-time year, really big move, but then a sizable balance before with short-term investments. You'll know here that I'll add back as excess cash flow. But overall, I really like the balance sheet. Income statement behind me is very clean. They don't give much detail here. It's basically revenue, cost of revenue, gross product being very large because they don't actually manufacture anything. They're just an e-commerce platform. So COGS is very low. Gross margin is really high. Marketing, product development, and G&A for a total OPEX of $836 million, relatively small, about half of gross product. So that means most of this revenue is translating to bottom line, which you will also see is translated to cash flow. So overall, I think the business model is very strong. There's not a whole lot of like other garbage down below the line of this operating income, which I like. That's strong, and you see continued growth over the years. So all in all, very, very strong. Shares outstanding, fully diluted and basic. Again, not a whole lot of movement here, relatively constant, which is what we want to see. All right, let's dive into the cash flow statement very quickly. All right, cash flow statement behind me. I know it's such an eye chart. I'll be very quick. It's basically pretty strong. A lot of the cash is transferring from the net income down to cash flow from operations. That's $678 million. If you can't see it, that's a strong number, up from $200 million previous, up from $200 million the year prior to that. All of those positive, strong numbers, which I really like to see. CapEx is relatively low, almost nothing, because they're a software company. We would expect that. They've got some acquisitions. They've got some internally developed software in here, which is fine. And then debt is relatively low. So overall, I think the cash flow statement is very, very clean. Income statement is positive and growing. Those, for me, check a lot of boxes. Let's go take a look at this in a chart form, so it's going to be easier to read. Okay, behind me is 9 years of financial data on Etsy. And you can see some of this includes pre-public information and public information, or rather pre-IPO and post-IPO information. Went public 5 years ago, which is about 2015 or 16, and the data shows strong revenue growth for over this 9 years, and I love to see that. So $75 million in 2012, very, very tiny on $3 million of Ebitda. Nice to see they're profitable even at that scale, and continues to grow revenue every single year. Absolute monster. Great job, team. I love to see that. With a complete destruction of a number in 2020, $1.7 billion, almost doubling, and more than doubling top-line revenue growth of previous year. You can see 111% year-over-year top-line revenue growth. But before that, they were averaging, that's an average of 30% a year for the last 3 years before this one. So I think the business itself is very well positioned. Top-line revenue is growing. Customers at every category are expanding, which is very, very strong. If we come over to Ebitda, which is basically operating income plus depreciation and amortization, you get this stream here. Really nice to see a startup e-commerce company kind of instantly profitable. You don't see many companies like this. Historically, most internet companies burn cash like it's going out of style for a long time. Really, mad respect for guys who can generate positive Ebitda at that scale and still grow top line. But you can see that has continued to grow strong every single year. This is a monster annualized growth number, mainly because this is so small. But even in the early, in these years here, aside from the big last year, they still put up strong double-digit earnings growth numbers. That's amazing. So they ended with $451 million of Ebitda, $1.7 billion of top-line revenue growth. Very, very strong. I think that checks 2 boxes for us. Let's take a look at enterprise value and debt. Here's debt. They did borrow some money, $1.1 billion of total debt, but excess cash, a little over $1 billion. So most of this cancels out. In fact, they've had excess cash flow the last multiple years because the business is cash flowing. I love to see that. And so when I net these two, they have very little debt on the books. Kudos to them. Market cap, average share price in December, that's the fiscal year end, times outstanding shares that I get from the P&L, and I get a market cap. I add market cap and debt, subtract the excess cash, and I get the enterprise value. Enterprise value is our entire value of the business, what we want to look at. And you can see $800 million, 1.3, 2.2, 6.1, 5.5, 21, and now it's sitting around $21 billion of enterprise value, which is a big company on really strong earnings. And as a result, you're getting strong double-digit enterprise value EBITDA numbers because it's growing so fast. Investors are willing to pay a high payback period because they believe that earnings are going to grow at a faster rate. And that's what you're seeing here. It's currently sitting about 45 times enterprise value, which to me is not cheap. Don't get me wrong. I think this is borderline expensive, if not expensive, but I'm seeing a lot of other things that I like here. So I can't say that it's going to get any cheaper. I would like it to be, but I don't want to let a good opportunity pass just because I'm waiting for the cheapest stock to come through. That might be, given this range of say 44, 41 at the low to 66 at the high, that might be the range it's going to trade in for a while. If we look at debt, it's essentially zero. Here it got a little high because EBITDA here has grown so much that this is now so low. So they did have debt prior to this explosive growth, but because they're so much larger now, that debt number has come down based on earnings growth. So that is a very good sneak peek. Again, I think this checks all the boxes for us as on debt, EBITDA, and revenue growth. This one, I'm going to have to take a look at the growth forecast before I can make a call on whether I think it's affordable or not. All right, let's take a look at cash flow. Here we are with the cash flow statement. We've got cash flow from operations. And what I like here is, again, all positive numbers, all growing mostly. Got one little dip here, but for the most part, it's all growing. And this number is growing in line with EBITDA, which means the accounting department at the CFO's direction is expensing things according to their cash need. And I like to see that they're not hiding assets or hiding cash flows. They're letting them flow through, and that is very strong. $680 million of cash flow from operation is a large, strong number for them. CapEx is absolutely tiny. It does not take them a whole lot of extra money to grow their portfolio. They basically expense it in R&D, so it's already out of this number, which means this number can flow through to the equity holders, which is you and I. That's what we want. We want a low CapEx to cash flow ratio to give us as much free cash as possible. If I look over here, debt payments, they were borrowing the last couple years. They did make an acquisition fairly recently, so some of this debt could be for that. But in this grand scheme of things, it's relatively small. We checked the total debt on their balance sheet. It's almost zero in terms of affordability. So I have no problem with that cash at all. Free cash flow to equity holders. This is what the company is valued on. $1.1 billion of free cash flow is an awful lot of money for this company to generate, half of which is the debt. So when I forecast to be conservative, I want to remove that and just take these two numbers, divide by shares, forecast that forward just to be extra conservative. But in my book, because they have so little debt, if they wanted to refinance and kick that as a dividend, a one-time deal, that's fine by me too. Shares outstanding. I was pleasantly surprised to see how well they have defended the equity holder here. A lot of companies that I look at issue stock like it's burning a hole in their wallet. But look at this. This is basically when they went public, and the post-public little sell down, they went from 114 million shares to 119, 120, 120, 121. There's almost no dilution in the last 3-4 years, which is amazing. And and they haven't really grown debt, which means if they're not raising equity, they're not raising debt, that means they don't need the cash to fund their growth. It's self-funding. It's a business that has high margins, that's doing well, and can fuel its own growth on its own, and it does not need to borrow money, it does not need to issue shares or bring other people into the party. These investors can stay as their ownership percentage of the business, get to stay in and participate in the growth without having to put another dollar in the business, and I like that a lot. That is a big one for me. Free cash flow to the equity holders per share, just dividing this number by this number, and we're approaching $10. Well, that's with this debt piece. It's probably a little over $5 if I take that debt out. Really, really strong. Share price has obviously moved up tremendously recently because of those earnings. And I think that's really where your risk is. You need to make a call as to this 2020 period, if it's an anomaly and it's going to kind of come back down a little bit and then return to that average, or it's going to build off this number. That's going to be, I think, the main risk here. And then lastly, cash flow from operations, the yield, 4.8%. That's a little high in my book. I've got this one, which is too high. I think that one's too low. I think I'm in the mid threes on this one. If I exclude this and this, I kind of pick out these four and I get it around 3.5 to 4% yield, I believe. We'll check in a second. All right, that's the cash flows. Let's take a look. We got revenue growth, yes. Earnings growth, yes. Low debt, yes. Strong free cash flow, yes. Well priced. Right now, I'm not willing to give a rendering on that. I want to take a look at the forecast and see if I stretch it out at a reasonable rate with a reasonable multiple, do I get a market excess return? Then I might label it as affordable. But right now, it's sitting at that kind of premium range to me. Okay, so the Ebitda forecast, what I'm doing is I'm taking the Ebitda last year and I'm growing it at 20% year over year. 20% is less than, if you remember, what they did last year with the doubling. It's also less than what they have done historically, because I think that while they're not going to decline year over year from this big 2020 year, I don't think they're going to grow at the same rate off this peak. I think it's going to settle down a little bit. So I gave it a 20 and I dropped it down to 10 pretty quickly just to be extra cautious, basically taking $540 million of Ebitda and growing it threefold to $1.5 billion long term. I'm putting a market multiple of 25 times on this business. That is a lot less than the 40 to 44 times it's currently trading at. So I do expect this market multiple to contract as the business stabilizes, as the business continues to grow. I think it's going to slow down, and I don't want my value to be pegged on a rich multiple such as 44. I need to bring it into something that's a bit more defensible for a business that ultimately would be growing earnings about 10% a year. A little less debt, plus the cash I think they'll maintain. I get a market cap of $38 billion. Divide by the shares. They're not diluting shares, which is good, so I think that's going to maintain. I get a $315 price target out 10 years. Cash flow forecast follows the same pattern. I have $5.58 up top. That's a growth of 20% year over year, with having removed that debt payment that is cash, but I didn't want to rely on that and forecast that for us. I just took cash flow from operations less the CapEx, divide by the shares outstanding times 20% growth, and I get this number, and I string it forward. I get $15.84. Again, kind of a 3x growth of the cash flow over the years, and I gave it a 4.5 times yield, which is the average of that range that I provided, excluding the 16 and the 0 because they were outliers. I get a $352 price target long term for Etsy. Here's our consolidating model. I got the two prices, one for free cash flow, one for market multiple. $352 of the cash flow method, $315 for the market multiple method, very close to one another. $334 if I just simply average them. I look into the public markets. I can buy the stock right now for $163 a share. If I put this into a simple IRR calculation where I get positive free cash flow, that I own the business, that business is generating that money, I can buy it at $163. I sell it at $334. I get this net stream of cash flow, and that is a 14% IRR, which is a market-beating IRR. The S&P 500 is estimated to do 10% over the long term. Might do a little less, might do a little more, but this is a good 400 basis points above that, which in my book is market-beating. You also expect about a 3 times your money over the long term by owning this stock. Let's review our 5 key attributes. So number 1, top line revenue growth. Yes, it's growing. Number 2, Ebitda growth. It's strong and it's growing. Free cash flow. Free cash flow is also very strong and growing. Low debt. Yes, it's currently 0. And well priced. Yes, I think it is well priced only because when I put in what I believe is a conservative forecast, I get a market-beating return. To me, that means the current price is reasonable. I would obviously like it cheaper, but I will go with what I can get. If I put it into a distribution curve, this is what I get. It's at $163, I'm at the 14% IRR. If behind me the math exercise pans out, it's assumptions, it's just a math exercise, but if it pans out, I get a 14% return. If for some reason the market should fall and I can buy this stock cheaper, I would absolutely do so, because anywhere near $150, I get close to 15%, which begins to get really interesting for me personally. I like to be up north in this side. Obviously, anybody does. But if you can find it, go ahead and do it. As it gets higher, to me, I would hold off. I think there are other opportunities out there, and I would not buy it. But right now, if you want to put a toe in the water with it, it's definitely a market-beating estimate. If it were to pull back, I think it's a great one to put on the shelf, look at every quarter, and if it hits the price target, go for it. So we're going to give this a good rating. I think I like what I'm saying for this stock. I like the management. I like where they're going, and I especially like the industry. This business in particular does not have to take inventory. It does not have to manufacture anything. It's simply a marketplace for people to exchange. And as a result of not having raw material cost, if you are concerned about inflation, having a company like this that is simply a conduit for people to exchange their product, they don't have to take physical possession of anything. They have very little exposure to commodity risk, and that could be a very good position for you to have in your portfolio. All right. My name is Cameron Stewart, CFA. Thank you very much. This is the review of Etsy. If you like this or you like what I do behind me, I do teach a course on rational investing, how to buy cash flow. Check out the description below where I provide this template, teach you how to run the numbers so you can review the thousands of stocks out there by yourself. I can't possibly cover everything. Thank you very much for all the comments. Hit the like and the subscribe button. Tell me what you'd like to see and comment down below. The guys on the channel off the chain on the comments on value-related stocks. So even if I'm not covering it, definitely take a look down below. There's always lots of very interesting companies to go for it and find. The more I do these, the more people are learning how to do this approach, and they're really starting to nail it in the comments down below, and I'm proud of all you guys. Great job. Thank you very much again. Really appreciate all the support. Thank you. This is Rational Investing. Bye-bye.